There are a number of provisions in the new Tax Cut and Jobs Act that affect businesses. One of them has to do with a choice of entity decision. C Corps now have a 21% flat tax rate. However, when deciding whether a C Corp makes sense, a taxpayer would want to take into consideration that once distributions are made to shareholders in the form of dividends, there's a 15% tax on that. Also, there could be an additional 3.8% investment tax on top of that. So weighing whether a C Corp makes sense or not is not as simple as just looking at the flat tax rate itself. In an effort to level the playing field, a new 20% deduction is now available to certain flow-through entities such as limited liability partnerships and limited liability companies. However, this 20% deduction is phased out over certain income levels of the owners, and there's also some alternative calculations depending upon the level of income that the owner is recognizing. There's an additional restriction placed on entities that are now defined as specified service trader businesses. These businesses are in the areas of health, law, and accounting, as well as some other listed businesses, except for architects and engineers. There's also a definition of a specified service trader business that includes any trader business where the principal asset is the skill or reputation of its employees or owners. The second aspect of the Tax Act has to do with the new rules for depreciation. Under the Act, depreciation can be taken 100% on property that's placed in service after September 27, 2017. Finally, there's also an increase in the amount that a company can take as a Section 179 deduction, up to $1 million. There's also one other big bonus in this new act as it relates to depreciation, in that used property can now be deducted as depreciation, whereas before it couldn't. These new depreciation rules may lead some acquiring companies to want to pursue an asset purchase rather than stock purchase, depending upon the facts and circumstances. The next aspect of the Tax Act that affect businesses has to do with the treatment of net operating losses. Historically, net operating losses could be carried back 2 years and the difference carried forward 20 years. Companies can now take up to 80% of the taxable income of the company and offset the net operating loss against that income. The carryback is no longer available, but the difference can be carried forward indefinitely. The last aspect of the Tax Act has to do with the expensing or the deducting of expenses relating to sexual harassment or sexual abuse claims. Under Texas and federal statutes, sexual harassment claims are employment-based, and what that means is that the company and not the individual is responsible. For sexual abuse claims, the individual can be held personally responsible. Once the claim has been made and investigated, that process can be a very expensive proposition. And so depending upon the outcome, a company now will have to decide the benefits of deducting the expenses relating to the investigation, defense, and actual payment of the claim versus the publicity that that claim can bring. So this could be a very important aspect of this sexual harassment or sexual abuse claim. At this point, the IRS has not issued any regulations regarding the new Tax Act. It's hopeful that sometime this year those regulations will be issued and some clarity will be given to some of these provisions.